2020, we had this flash crash. Gold and silver fell off a cliff. Gold immediately starts coming back up again, as it should, as a monetary metal should, as a safe haven asset should. And silver just kind of stayed on the mat, right? It's been struggling just to get back, and it still hasn't hit a new all-time high, nominally even, as gold has. So the market now is the data is telling us something is different. And you could, I suppose, chalk all of that up to manipulation, but the scale of manipulation to keep silver in the 20s when gold is over 2100 globally, it's just not credible. It's not an easy thing to believe.
Silver must catch up as gold prices soar to unprecedented highs due to its primary use in industry and comparatively lesser status as a safe haven asset. Yet, the broader industrial applications of silver and projected supply deficits suggest a potential shift in its favor. While gold has dominated since 2016, the tide may turn as silver's industrial demand gains momentum. The Silver Institute anticipates global silver demand to hit 1.2 billion ounces in 2024, driven by robust industrial usage reaching new highs this year. Lobo Tiggre, editor of the Independent Speculator, notes a significant uptick in industrial demand for silver. He suggests that gold and silver would benefit in a recession, leading to a hard landing as monetary metals gain traction. Conversely, a thriving economy would spur industrial demand for silver. Throughout history, silver has often emerged as the shining star in the later stages of bull markets, even after initially lagging behind gold. This historical trend poses a dilemma for silver investors amidst the current consolidation phase since 2020, leaving them uncertain about silver's future trajectory. Traditionally, silver has been known for its higher volatility than gold, indicating more significant fluctuations in price. However, recent years have seen a shift in this perception, with silver exhibiting less volatility than expected, prompting questions about the market's underlying dynamics. While concerns persist about market manipulation, Tiggre contends that attributing all market movements to manipulation appears implausible considering the scale required. He emphasizes that market data suggests a shift, challenging conventional narratives and underscoring the necessity for a nuanced understanding of market dynamics. Concurrently, despite silver wrapping up the week with marginal gains and showcasing impressive monthly and quarterly performances, it continues to trail behind gold, equities, and cryptocurrencies. Despite this divergence, bullish sentiments persist, buoyed by the ongoing upward trend. Stay tuned for excerpts from Lobo Tigre's interview with David Lin. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
To say that there's been a change in the relationship between gold and silver. And these numbers that you're pointing out are case in point, right? The use case has changed. And, the good news is that clearly there's a vastly increased industrial use case for silver. And I do think that is good news because, the investment case, the monetary case doesn't necessarily go away. And so if I'm right about the hard landing and monetary metals get a bid because of the recession, then that would be gold and silver. That'd be good for silver. If I'm wrong and the economy takes off, well, that's good for industrial demand for silver. So that's good for silver, not so much gold. So, people call me Darth Silver and all that, but I'm not anti-silver. I'm not even a silver bear. The reason for the name, though, is that something has clearly changed. These numbers that you're pointing to, you can see it on a daily basis. There's, over the last year or two, you look at gold and silver and copper on a daily basis, and the silver line intraday will frequently wiggle more with the copper line than with the gold line. It seems to be responding to the same stimuli, to the same decisions that copper buyers are making than gold buyers frequently. Now, it is still money, of course. It is the word for money in many languages. And especially since the new war in the Middle East broke out, we've seen silver go back to tracking gold more closely. I find this very reassuring. Yes, it is still a monetary metal. So I like that win-win thesis. And you said that silver outperforms gold. Well, even diehard silver bulls will tell you it outperforms gold at the end of the bull market. It typically lags at the beginning and then more than catches up at the end. So if we're going in, we've been consolidating sideways since 2020. We're going on 4 years, David. This is no longer the same bull market of 2019, 2020. If we break out again and and we seem to be doing that on the gold side, history tells us that silver will lag it first anyway. If you want to be fanatical about defending your favorite metal or commodity or whatever, fine. Not, knock yourself out. If there's an ideological agenda here, fine. But don't mistake that for being an investor. If your goal is to make money, what David is saying right now, I mean, this is like truth with a capital T. These are the facts. Just look at it. In 2020, we had this flash crash. Gold and silver fell off a cliff. Gold immediately starts coming back up again, as it should, as a monetary metal should, as a safe haven asset should. And silver just kind of stayed on the mat, right? It's been struggling just to get back to, and it still hasn't hit a new all-time high, nominally even, as gold has. So the market now is, the data is telling us something is different. And you could, I suppose, chalk all of that up to manipulation, but the scale of manipulation to keep silver in the 20s when gold is over 2100 globally, it's just not credible. It's not an easy thing to believe.
As the Federal Reserve convenes its March policymaking meeting this week, interest rates persist at a 23-year high, underscoring the economy's resilience. Despite low unemployment rates and soaring stock markets, lingering concerns about a potential recession persist. Historically, mounting borrowing costs have often triggered economic downturns in the US. However, this familiar pattern has yet to manifest in the current economic landscape, contributing to investor uncertainty. Many market participants, including Lobo Tiggre, anticipate a scenario where the Fed would enact monetary measures and fiscal policies to counteract recessionary pressures. Historically, there has been a significant uptick in demand for monetary metals like gold and silver during recessions. These precious metals serve as traditional safe haven assets sought after by investors during periods of economic uncertainty. However, Tiggre emphasizes the importance of distinguishing between monetary metals and industrial metals like platinum and palladium. While monetary metals benefit from economic downturns due to their perceived store of value, industrial metals are more closely tied to economic activity and may exhibit different price dynamics. Let's get back to the Lobo's interview.
The Fed has trained the markets. It's almost a Pavlovian thing. And that's why we've been scratching our heads about bad news being good news for Wall Street for years because of the expected Fed put. And in this case, I think that's not an unreasonable expectation. I think if we had the Fed's second mandate called in, that they would pivot, fast as you could. And not just monetary policy. I think we'd see a fiscal response. And markets are forward-looking. So markets could look at a recession and say, yay, the floodgates are going to open. The easy money is going to flood the markets and the money helicopters are going to fly. So, hey, go long, go risk. It's important not to conflate the two, market crash with recession. But if the reality on the ground is recession, those have been historically always very bullish for monetary metals. That's gold and silver, not platinum or palladium or rhodium. Sorry. Those are industrial metals. So it's primarily gold, secondarily silver. It's also, at the outset at least, depending on monetary policy, the fear can be good for bonds, but we have to see how that works in uncharted waters. It's bad for industrial minerals and commodities. And it should be bad for the stock market as a whole, but it probably will be bad for commodities. So commodities markets don't seem to get the same treatment from Wall Street that the equities markets do. And bad news is just bad news for commodities. If there's a downturn in the economy that's bad for iron, it's actually arguable whether the Fed can save anything. Here we are on Fed Day. And what they do, does it really matter? Their toolbox is actually quite limited. And if it's fiscal largesse, that's really still that pig working its way through the python that's making inflation sticky. Do their interest rate decisions really matter that much? Are they trying to hammer a screw or turn a nail? I think it's not much of a stretch to say that there actually is a global recession going on. We're not just looking at indicators, we're looking at a reality right now on the ground. And then the question is the US the exception? Does American exceptionalism apply here? And I would argue that again, we're in uncharted waters, but given how we got here, if we have the post-COVID distortions in the labor market, the labor hoarding, the companies not wanting to fire people they really don't need because of how hard it was to find people during and after the COVID situation. So then that pillar that this American exceptionalism rests on, of the strong consumer laborer, right? If that is not as strong as it looks, or if it's artificially been propped up post-pandemic and then that breaks down, then things change in a big way. So if you want a headline, David, my headline is Lobo Tiggre doubles down on hard landing. I really do think that's coming. I think that the degree to which these things that I'm talking about, labor hoarding, post-pandemic distortions in the market, have prevented or held off the recession from, the piper from being paid. The degree that you hold him off, that you increase your interest payment when he does show up for payment. So I think the hard landing, left to its own devices, would be much harder than it would have been had it been left to sort itself out. And then the question, of course, becomes, what do the powers that be do? So I'm doubling down on hard landing, but I do think the money helicopters will fly. And the timing of this is really the critical point.
While gold often dominates headlines as a safe haven asset, silver is quietly emerging as a compelling investment opportunity, backed by robust fundamentals and favorable market conditions. Analyzing futures prices and supply-demand dynamics, it appears that silver futures could outperform gold this year, potentially surging to a 10-year high of around $30 per ounce. This bullish outlook by many investors for silver reflects growing investor interest and confidence in its long-term prospects, making it an attractive option for those seeking exposure to the precious metals market. Share your thoughts on Lobo's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.